Welcome back to the Banking on Digital Growth podcast. I'm your host, Derek Kraus, and today I'm joined by Chris Allen, who is the CEO of Fox Communities Credit Union. I invited Chris to the show because toward the end of last year, we had a really interesting conversation, and I believe he has some valuable perspective to share with credit unions and banks about how to approach disruptive innovation and technological change so that you're set up for success. If I were to summarize what Chris has to share, I would say that it comes down to structuring your organization and your priorities in a way that you have the ability to be flexible and adaptable. I'm excited to share this conversation with you. Let's dive in. Hey, Chris, welcome to the show.
Hey, thanks for having me, Dirk. I appreciate it.
Yeah. So we talked a few weeks ago. Was that maybe a few months ago? Was it November, December, something
It
like that?
probably could have been, a couple months ago now.
Yeah. I really enjoyed our conversation, which is why I wanted to invite you to come on the show, because I think that perspective that you have to share around how you're thinking about innovation and what sort of things have the potential to disrupt credit unions, and also how to approach that strategically, how to respond to it, is interesting.
Yeah.
And so I felt like it'd be valuable for you to come in and share that with the credit unions and banks that listen to this show. And so
Sure.
we were talking quite a bit about the innovator's dilemma. And the way this started is I've been talking quite a bit with Melanie, who is fantastic, by the way. I invited her to come and record a podcast episode as well. So I think we're going to do that in the next few weeks.
Our chief marketing officer,
Yeah. And she and I had talked about just what I view as disruption that's happening, and we can talk more about what disruption means. I think anyone that's listened to past episodes of the show, I talk about the innovator's dilemma a lot. But I was talking with Melanie about that, and she said, "Oh, yeah, Chris and I have talked about like maybe on the business lending and business banking side of Fox Communities Credit Union, like there may be an opportunity to really build that up more as like a standalone business." And then you and I were talking a little bit about that, but even more generally about what I view as disruption that's been happening for the last two decades in banking, where credit unions grew up in a world that's branch based, and now the internet came along and made it so that there are still people that prefer to go to physical locations for banking, but it's not required. So you've got this branch-less model, and now there's a lot going on with AI, and I know you're doing things to prepare for that. So I just wanted to have a follow-up conversation about innovation in general, and how you see some of the current trends impacting credit unions, how they can respond to that if you're a credit union or a community bank. So that's kind of the background here. So let's talk more specifically. So when we had talked about this before, I thought it was really interesting, your strategy that you're trying to pursue with Fox Communities Credit Union, because I had mentioned that in the book, The Innovator's Dilemma, the author, Clayton Christensen, he was saying when there's a disruptive innovation that comes along that's changing the game. So, for instance, like being branchless instead of branch-based.
Sure.
One possible response to that is to completely transform yourself. So close all of your branches, become totally branchless. And he pointed out that that's usually not successful, just not a successful strategy because it's so much pain to go through that transformation. An
Sure.
alternative strategy that he's found that typically works better is to launch a spin-off brand so that that new brand can operate under the new innovation without being smothered by the parent organizations, like smothered out of existence, basically.
Sure.
But then you had mentioned what you're trying to do at Fox Communities uh, instead of launch a spin-off brand at that point. I want to talk a little bit more about that as a possibility, but you had mentioned that you're trying to treat the different operations of the credit union as that they need to each be able to stand on their own, right? So,
Yeah.
uh,
Yeah.
tell me more about that.
Yeah. So Fox is a nice size credit union. So we're about $3.3 billion, and we have a larger array of product lines than a lot of credit unions do, including business lending. And because of our size, we've got a little bit more resources to throw at the virtual banking environment, continue to expand our retail, continue to do the types of things that we need to do for our legacy members, but then also potentially trying to attract new members. So one of our, but at the same time, we're not large enough to throw a bunch of money at, say, mortgage to compete with Rocket Mortgage at the same level of innovation and technology, or some of the fintechs that are coming out with the same level of innovation and technology.
Mm.
So what we're really kind of focused on are what are our growth opportunities as a credit union? What are the larger areas? You know, we continue to see a lot of nice, reasonable growth in our traditional retail, our branch environment. Even though there's a lot of people saying branches are dead, there are quite a few people saying, no, wait a second, no, they're not. So we continue to kind of lean into that, you know, trying to find ways to make them more efficient, trying to find areas that we're not in yet that maybe our branches might be successful, a very traditional kind of expansion plan in that area. Another area that we believe that we have opportunity is in the commercial space. We are actually a credit union that has for a very long time really done well in the business lending space. There aren't a lot of credit unions that do, just
Yeah.
because we haven't grown up in that space. There's some regulatory we'll call it handcuffs that get placed on credit unions in general that we have basically kind of worked our way into, hey, we're kind of experts in this space. It's actually the space that I grew up in. I was a commercial
Oh, really?
lender up until I became the CEO. So I've got a lot of experience in that with the SBA lending and all the other things. So that, along with hiring some really good talent over the last few years, we believe that we can compete very well against any other credit unions and other financial institutions that offer commercial services. So we believe that is a growth area for us. And then the third area that we're focused on is the virtual space. And that's largely because, you know, that's where the world is going. You know, think Amazon. I mean, how many of us 10 years ago, you know, went to Walgreens to buy our toothpaste, and now I buy all my toothpaste, deodorant. I mean, basically any of my HABA. I actually worked in grocery for a little bit. HABA health and beauty aids. You know, I used to go to the grocery store. I used to go to Walgreens to get it. Now I just order it from Amazon,
Yeah.
and the world is just changing around us. So we see as much an opportunity as a need to stay relevant in that space. So those are three distinct spaces: commercial, retail, and the virtual. Each one feeds off of each other in the traditional sense. You know, there's a lot of overlap in that Venn diagram. But what we've decided is hey, we're going to take each of these three areas and say, okay, how can we design them to work together today like they should traditionally? You know, the virtual should support the retail because, you know, the omni-channel approach, they should be able to. but at the same time start to develop them so that they could stand alone if they ever needed to. If the world ever changed significantly enough to where one of those three couldn't be used as a potential growth source. Take commercial, say some regulatory changes happen, say something else happens and commercial is not available. Well, we still have our retail presence both in the virtual and in the retail space. Say the traditional, branch network starts a slower decline. Well, we've got our commercial and we've got our virtual that can step up and kind of work, somewhat independently of that to continue to facilitate the growth that we need as an organization. And say something happens in the virtual space where we're just not going to be able to compete. Well, we still have the commercial and the retail that we can continue to focus on and do that. So if we're setting each of these up so that they aren't required of each other in order to survive, then we can pivot as the market starts to unfold. It's kind of like putting bets on, at the roulette table on several different numbers. You really want to try and say, okay, what's our best chances? Let's make some bets, but make sure that we're doing it in a way that provides the most flexibility in an uncertain world, how this is going to unfold. A year or two ago, it was, hey, it's all going to be virtual. Now you're starting to get some feedback that, nope, the next, the Gen Zers, the folks that are coming up, really actually kind of like the idea of a branch where they can go in and talk. So you're starting to, the world is just changing around us. We know that for sure. The way that people like to do business is changing around that. We know that for sure. How exactly that's going to play out, that's the part we don't know for sure. So if there's a way for us to hedge our bets in a couple of different areas and still achieve our growth goals, then that's the way we kind of approach it. It's a way to maximize our opportunity for success through uncertain times, essentially, is the way I look at it. Now, I do want to take a step back because, especially in credit union land, there's been a little bit of, well, why is everybody so focused on growth? Why is everybody so focused on growth, from that standpoint? And it's a weird concept, but it's actually one that's really interesting in credit union land. So if you don't mind, I'm going to take a minute or two just to kind of
please do.
Talk about it. So, we're not-for-profit cooperatives. I mean, really, we're here to just create the best financial institution we can for our members, and the reason we have so many credit unions is because we've got, different groups of people that we're working with, trying to tailor our offerings to the communities that we serve. And that's wonderful. And there's a lot of small credit unions and there's a lot of big credit unions. And one of the pushbacks that we get is, hey, everybody's so focused on growth these days, that are we losing the credit union feel, the atmosphere around credit unions, what made us special to begin with. And I can appreciate that argument, but at the same time, what we have to realize as a group is that our business model is one that relies very, very heavily, if not almost exclusively, on net interest margin. We bring in deposits here. We take those deposits and send them out to loans at this level, and that spread is what we have. And historically, that spread has remained relatively consistent. It expands, it contracts, but it's been relatively consistent. Now, at the same time, our costs don't stop rising. Our people need raises. Salt for our driveways costs more. Electricity costs more. Buildings cost more. All this stuff starts to happen. So if our net interest margin is a relatively fixed number, but yet our costs continue to rise, really our only way to combat that is through growth. Now, you could do that with some cost savings, some efficiencies, some of that type of stuff, which is all well and good. But those are actually shorter term type of measures, because eventually you're going to run out of costs to save. So you need to continue to plant the seeds of growth so that we can continue to meet the general growing, the general expenses associated with growing. That is why growth is so necessary, and that's why it's important for credit unions to be focused on whatever growth is going to help them, kind of make sure that they're staying in line with their costs. Otherwise, it's going to be really, really tricky for a lot of credit unions if they're not planning for growth. Now, it doesn't have to be 10x, 20x, 30x, like you would if you were in a, high tech, investing space or something like that. But you need to make sure that you're continually trying to plan for that growth. Otherwise, you're going to find yourself in a space where you're not going to be able to keep up with your expenses. That's going to be the surefire way for your organization to struggle, and therefore the thing that you are fighting against, which is having to consolidate and merge, all of a sudden starts to happen to you against your will from that standpoint. So for us, focusing on growth is really coming from that, so that we can stay relevant, so that we can continue to meet the rising expenses, and we can continue to do things that we need to. And we're looking to do that in an organic way, which is why we are planting the seeds in those 3 different areas to kind of keep us in a spot where we will have growth opportunities through member acquisition, traditional means from that standpoint, without having to necessarily merge to create efficiencies and scale and stuff like that.
It's interesting that you're talking about growth and how there's pushback about growth.
Yeah.
So the founder of Nike, Phil Knight, he wrote a book called Shoe Dog, and it's really good. It's basically a memoir of how he started Nike and grew Nike. And there's a philosophy in there that he brings up time and again. And the philosophy is simple. It's grow or die.
Yeah.
And I'll be honest, when I've listened to that book a couple of times now, and the first time I was like, really, are those that seems pretty absolute. Like, you can also just stand still, right? But that was a few years ago that I first listened to that, and I listened to it again more recently. And I think just based on experiences that I've had in my own business since then, I'm buying in more to that point of view that it's like if you're not actively trying to grow, then usually what that means is you're actually going to go backwards, or you're going to try and stand still, and everyone else is trying to grow and move forward. And so it's like, as a result, you're shrinking anyway.
Yeah.
So
Yeah. Yeah, I was. It's and again, I don't want to make it sound like you have to grow to be a 50 billion, $100 billion shop in order to survive. That's not my case at all. What I am pushing forward. That's not what I'm pushing forward. But if you're not intentionally growing or trying to grow at a rate that is going to be able to keep up with even just inflation, the cost of everything, which if we sit back and rely on, just our members getting more money each and every year through pay increases, then that's kind of where you land sometimes. You're going to have a hard time keeping up. That's not even to mention that, the cost of all the technologies that people are really, really wanting these days, that are now starting to become table stakes, just continue to go up, and you need to add them to the stable of products that you offer, which is going to increase your costs. So if you're not intentionally growing, and again, it doesn't have to be 10, 15, 20x, but if you're not very intentional about kind of your growth strategies, you will start to go backwards and have to do things, austerity cuts that you don't want to do. It's like, well, we didn't grow enough, so now I got to cut 3 people from my staff.
Yeah.
And I tell my team that, and I've been CEO for 6 years now. Probably be CEO for at least another decade, maybe a little bit more, from that time point, if all things go well, from that standpoint. And if I can get through my tenure without ever having to do RIFs or reduction in force, because we didn't plan right, or we were not successful in at least a keeping pace growth strategy, I will be very happy. We're a very people-centric shop. We got 510 team members right now, and I hope each and every one of them are with us for the next decade, and that we don't ever have to right size the ship because we just missed something
Mm.
from that standpoint. That is probably, if it's not my major driving goal, it is one of my major driving goals, is to make sure that our team is taken care of, the people who take care of our members is taken care of. And in order to do that, I need to really kind of be intentional about making sure I'm keeping up with, with the right strategies and stuff like that.
This is a really interesting topic to me that I haven't talked with a lot of people at credit unions about, but I think it's really relevant because so as an entrepreneur, I'm like, yeah, you want growth so that
Yeah.
I can be successful, so I can earn profit. And if there's not growth, then like that's not a good thing. It usually means we're either standing still and about to go backwards or already going backwards. And so I know a lot of credit unions look at or like, I shouldn't say credit unions. Some people in the credit union uh, world will talk about profit being almost like an evil thing, and it's the thing that separates credit unions from banks. But you're bringing up a really interesting point where, so if you're a bank or an entrepreneur or a for-profit business, there's the owners of the organization have a built-in incentive to want to make it grow and to help drive it forward. So where uh, credit unions are structured differently, of course, as not for profit. You still want to be profitable, but not for profit.
Yep.
And I think the core thing that we're hitting on is that growth is still important to credit unions, especially if you want to be relevant. If you're not growing, it kind of means that you're not providing something that a lot of people find valuable. So they're not coming to you to get it. And the quickest way to go out of business is to be irrelevant to people. So how do you create the incentive for growth without, okay. The way I've always thought about it is that the organization as a whole is not for profit, but the individuals that work in the credit union are still for-profit individuals, as in like nobody's coming to work for free.
They're intrinsically motivated. Yeah.
There's that.
And,
Go ahead.
And you actually, so the short answer is you hit on the exact how you keep the, like a kind of a growth mindset, is by making sure that that you're, this is how we do it. I'll put it this way.
Yeah.
I'm sure there's other ways, but we're putting our team, our people, kind of at the forefront of what we do. So our three key stakeholders are our members. Pretty simple. Our communities, it makes sense, from that standpoint, and our team. So as the CEO, I'm constantly focused on making sure that our members, communities, and teams are taken care, and team is taken care of to the best of my abilities. And then when you think about, if those are your three key stakeholders, then, what do you do with the revenue that you generate and the quote unquote profits that are made? Mm-hmm. So the very first thing we do with our profits are put them into our net worth so that we stay safe and sound. Because if anything happens where the economy goes down or something like that, the very last thing I want to do is lose mom and dad's money and put us in a position where, we're struggling and then people don't trust us, et cetera, et cetera. So that's the first thing we have to do, is put, roughly 10% of our growth, into that savings account to make sure we're safe and sound. Yeah. The second thing we have to do is reinvest back into the organization in terms of staying relevant, because you're absolutely right. You can think of relevancy as you're either relevant, staying relevant, not relevant, or you're just right? So if you're not relevant, you're gonna continue to start losing members. People will leave. People will pass on, and you won't be bringing in new members because you're not relevant.
Mm-hmm.
If you're relevant, if you're keeping up with it, now you're attracting new members. You're continuing to add to the group of people who are pooling their resources together to create this cooperative from that standpoint. And it is almost impossible to stay just right, because you're just relevant enough but not quite relevant. You're just right to keep the bucket full.
Yeah.
The amount that's going out the bottom is coming in the top. That is very,
It
very
doesn't seem like a
difficult. So
good
you need
place you want to be anyway.
It's not a good place, because that can shift very quickly on you, as we're seeing with this AI stuff and everything. So you want to make sure that you're focused on staying relevant, and that's where a lot of investment needs to be. But the other way that we reinvest back into the organization is into our team.
Yeah.
From that standpoint, because again, our value proposition out there isn't so much based off of price; it's based off the relationships that we're creating, with our members and our communities. We're part of this cooperative that's really trying to create the best financial institution we can. So if we're reinvesting back into our team, that is a way for us to stay relevant from that standpoint, and making sure that they've got great training, that their leadership and development, that we're hiring the right people. That's actually super important. People who are motivated by wanting to make a difference in other people's lives are the type of people that we need, because that will help them want to drive the growth, and understand what our mission is, which is to pull more people into our credit union so that we can continue to stay strong and continue to stay relevant and bring our brand of financial institution to everybody. So if we're investing back into these people through that, as well as through compensation, trying to make sure that we're compensating them. And in fact, this time of year, I go to all the branches and say hi, spend about 2.5 hours with them, talking about our strategy and what's going on and hearing their concerns. And I just had this conversation this morning where we take our profit. And again, you can think of it as surplus because we are a not-for-profit, but our surplus revenue is making us safe and sound, and then putting it back into the organization, which includes providing opportunity for us to grow within the organization, and to have salary increases and create good careers and do those types of things. But in order for us to do that, we need to continue to grow because of that net interest margin thing I talked about a few minutes ago. We need to continue to grow so that we got the resources to reinvest back into you, our team, and to do that. And that's actually been a really nice message for our team. That gets the motivation of, I understand why we need to grow. I understand why we need to try and pull more, members into the mix. I understand why we need to take members who might have only one thing with us and maybe help them realize that we got 2 or 3 things that could help them. All of that helps us continue to generate the type of income we need to stay relevant and to take care of, one of our key stakeholders, which is our team. Now, the other part of that is, at some point, if we're very, very successful, when we're very successful now, but if we continue to become more successful, then at a certain point, we just don't need the money to reinvest back into the organization. What we do is we take that, we return it back to the members by starting to lower our fees, lower our rates, do the types of things that we need to do to basically get it back into our members' hands from that standpoint. And that's really how we approach it. Quite frankly, I don't see the need to make much more than 110 ROA, 1.1%, return on assets, because quite frankly, we're meeting all of our needs at that number. If you start to get to 120, 130, 140, well, then you're probably charging too much. Maybe you want to, return that back, unless you have a very specific goal in mind. So that's how we do it, is really by showing our team that they are the difference, and that by helping the organization grow to meet the upcoming demands, it's going to help them out in their careers. They're going to be prosperous. Our members are going to be prosperous, and our communities are going to be prosperous.
Yeah. So, and let's, so as we've been talking about growth, I think I'm really interested to hear where you see the most potential for growth for the credit
Yeah,
union, for Fox Communities, but also perhaps for credit unions as a whole. And I assume it's going to be in one of those three different areas that you talked about. So you've got your
yeah,
traditional branch based operations, you've got the business operations, and then you've got the digital operations. And I'm very interested in talking about all of them for different reasons. Um,
sure.
I'm interested in talking about the business side because you mentioned that not a lot of credit unions do it.
Yeah,
And so I'm very interested in differentiation because I
yeah,
think a problem that a ton of credit unions are facing right now, and community banks for that matter, is they're just the same as everyone else.
yeah,
They don't. So that was fine in a world where physical location mattered. You know,
yeah.
pre internet, if you were going to do banking, it was inherently physical for the most part. Maybe you could do some stuff by the phone.
Sure.
So just being in a community is kind of all you needed. And obviously, you needed to provide good service, and you had to have products that were
Yeah,
on par. But as long as you were doing that, just having the presence is what mattered. But now, where physical location isn't a requirement, some people still care about it, and I want to talk about that too. But
yeah, yeah,
there are a lot of people today that don't care about the physical location of the credit union or bank, and so then these financial institutions are left with nothing really solid to compete on because their checking accounts are basically the same as everyone else's. Their auto loans are the same as everyone else's, and
yeah,
so it seems like with business, uh, it sounds like there's some background expertise there from you and in the organization now. But is part of the reasoning there that it's an opportunity to differentiate yourselves in ways that other institutions are not, or tell me more
yeah.
about that.
Yeah, so on the business side, having grown up in that space, uh, I am a firm believer on the business side that it is and will continue to be for a long time, much more relationship
I've
based.
heard that from
Especially
others
at,
too.
at
Yeah.
yeah, especially at some of the more complex, business needs. The the partnership between the financial institution and the business is much much stronger because of the needs, because of the uniqueness of each business.
Hmm.
They're very hard to bucket into similar groups as everything because each one has unique pressures, unique business models, all this other stuff. So I think the commercial space, excuse me, the commercial space is for a long time going to be still heavily relationship
Mm.
based from that standpoint.
Yeah.
And if you take that if you ascribe to that philosophy like I do, then the model is actually not super tough of how you differentiate. It's the people you hire.
Mm.
These are relationships. With your banker. So your banker and you work together. You create strategies of how you're going to finance what they're trying to do for the growth. You take care of them when things get tough. You've been with them through thick and thin, whereas others in their past may have cut them off because their risk was too great and that type of stuff.
Yeah.
And that's where I think credit unions can do very well because as the not for profit, we're really set up to try and help all of our members, individual and business, through difficult times much uh, well we lean into that a lot harder than a lot of banks do. And I understand, I'm not banging on banks. I don't mean anything, but it's like, okay, we can spend a lot of time kind of helping shepherd this thing through, or we can cut our losses now and work on something that's more profitable going
Mm.
forward. And I understand that business model. Credit unions are different, though. We're here to help people. We're here to help them build stronger financial futures. So if you take that and you say, hey, we're going to be there for people, and I'm going to work with somebody as long and as hard as I have to, until the point where it's going to hurt the rest of the membership. That line is a lot further than traditional banks can do, especially larger banks.
Mm.
From that standpoint, community banks probably fall a little bit more closer to what I'm describing, but larger banks for sure are more, hey, we got to cut our losses and move on to the next thing. And that provides us with a wonderful differentiating point, against a lot of banks that are in the commercial space, especially a lot of the larger banks, from that standpoint. So if we can do that, we can marry it with a banker that's experienced, that has built relationships, has built trust in the business community, that they can then say, hey, I found this model, this credit union model that's going to meet all of your needs and then some. And oh, by the way, the value proposition is, hey, we're not for profit. I don't have to make $1 off of you. I just need to charge you what is fair, to cover the risk, the cost, the things associated with it. After that, it's really, I'm not trying to make an extra buck so that, Grandpa Allen can buy a yacht because he's the shareholder at the bank. I'm just trying to make sure that we're charging what's fair. That whole value proposition, and if you got the right people in the right places who built those relationships, over time, credit unions can do very well in that space. So we differentiate very well against most banks. And then the simple fact that a lot of credit unions aren't in that space, we obviously have less competition from there. So it really is a really nice space for us to take a look at and do. And then the banks will say, oh, credit unions don't know what they're doing. It's like, well, I don't know. I mean, a lot of banks have people who are younger than me running their shop, and then they've got less experience than me doing that. And my chief lending officer was commercial at a large financial institution, and the
Mm.
lenders we have a total of over 200 years of experience. So I'm really struggling to figure out how we don't have the expertise to handle this, from that standpoint. And you know. That relationship building. Now, I will say for credit unions, the one thing that has held some of them back is that it's expensive.
Mm.
Good talent in the space is really expensive. The tools are expensive, and if you're not willing to make that investment in the talent and or the tools, you're going to struggle. And that's where some credit unions have kind of faltered when they've tried to do that, is they just haven't been able to swallow the cost of what it would take to bring in a good relationship manager, vice president relationship manager that has built those relationships and would create that engine. They just haven't been able to kind of get over that hump. We did a long time ago. In fact, when they hired me, they kind of got over that, from that standpoint. And then, as time went on, we've kind of built a really nice portfolio.
It's interesting that you're talking about relationships being the most important thing there, because
Yeah.
I had a conversation a little while ago last year with a gentleman named Corey LeBlanc at Locality Bank. They're a new bank that started 3 or 4 years ago in South Florida, and they're primarily business focused. And he told me the same thing, that it's relationship driven. And then when I think about my own experience with banking, so for my personal accounts, I I have most of my money in Ally Bank, but
Yeah.
then business accounts, we have accounts with Mountain America Credit Union, which is based here in the Mountain West. And uh, over the years, there's been like some rep at MACU that's assigned to our business. Now, we haven't had a very close relationship with them, but it'd be nice if we did. And we don't have a ton of banking needs. Like we don't have any debt or like we just operate with cash. So, but every business is different, and I can see the value there. Every once in a while when we do need something, I'm like, oh, who's my rep again? I just want to reach out to that rep so they can help us with this. Versus on the consumer side, like I mostly just want to do stuff online,
Yeah.
So I
Yeah.
can see the difference there.
So yeah, so if you think back to kind of the three-pronged approach that we have, one of the reasons we picked commercial was because it is heavily relationship based, especially the stuff that's larger, more complex, that helps drive a lot of growth.
Yeah.
And quite frankly, it really, and this is where I think a lot of people miss the boat, is that commercial actually is probably the best way that we have to help build stronger financial futures for our communities, which is, again, one of our key stakeholders from that standpoint, because commercial lending is really at its core economic development. I mean, we're helping, small businesses get off the ground, and, rent places and hire people. And we're helping manufacturers, buy new equipment for this new product line that they got, and that they have to build a new building for, or something like that, which adds to the tax base and adds 15, 20, 30 new jobs. And we're helping people who own apartment complexes build 40, 50, 100, 200 units in an area where housing, units are actually kind of one of our issues that we need to continue to do. We help home builders build affordable housing, and I'm going to say affordable housing because I don't think any housing is affordable anymore, especially new construction. It's just nuts. But our point is that like this commercial area really is economic development, and if one of our key missions is to help our communities become stronger, then we have to be able to step up and help these entrepreneurs and small business owners cultivate, and grow their businesses by leveraging some of the services that we have, so that they can add jobs and they can add to the tax base and they can do all this other stuff. So I think it's, but getting back to my original point, the commercial space is going to be driven, not all, but largely by relationships for the foreseeable future. Other spaces, as you noted, might be migrating more towards self-service, which isn't quite as relationship oriented. So, if we're hedging our bets a little bit and we're trying to figure out where the next, where our growth engine is going to continue to be, well, having one that is really, truly relationship based, that probably isn't going to go away if stablecoin becomes a big thing, or the fintechs, finally kind of, coordinate and take off like wildfire, or the big banks do something that, is attracting too many, like, that's a space that they're going to have a hard time necessarily beating our relationship model from that standpoint. So that's why commercial is one of those areas that we chose to kind of, be a strength if we can make it that, which we have, but if we continue to make it that.
Yeah, that makes sense to me, and I like that it gives you a strong competitive angle, because it's, as you said, based on relationships. You were, I want to talk about the other two, the other two pillars as well, and because this is where I see potentially more friction, potentially.
Sure.
So, you mentioned some people saying that branches are dead, and I think it's a little more nuanced than that. I think that statement can be both true and false depending on who you're talking about. Dead for who? So, because there are still lots of people that want branches. There's still people that go to branches on a regular basis, right? And I was talking with my mother-in-law recently. I was like, how would you feel? Her name's Shauna. Hi, if you listen to this, Shauna. Hi, Shauna. Love you, Shauna. Uh, I was asking. I said, how would you feel about uh, banking with a credit union or bank that didn't have any physical branches near you? And she was like, no way, wouldn't do it. And I said, oh, how often do you go to the branches? She was like, oh, maybe like 4 times per year. So it's kind of
Yep.
interesting. She doesn't go a lot, but she does go. Whereas me, on the other hand, I don't think I've been to a branch in like, I don't know, 5 years, and I
Sure.
prefer it that way. Um,
Yeah.
to me, it's an inconvenience. For other people, it's like an important aspect of their banking. But it seems so, and I may be generalizing here, especially in light of what you said about uh, Gen Zers, but it seems like most people that want the branches skew older generation.
Mhm.
Um, and I've heard this now from a lot of people with Gen Z that they're some of them are visiting branches. I'm a little bit skeptical, I'll be honest, and I'd be interested to hear your thoughts on this. And I just look at that, I'm like, okay, is that a permanent thing where throughout their whole lives they're going to want to visit branches, or is it more because they're young and naive about finances, and so they get some measure of comfort uh, by going and talking to someone in person, but that's a temporary phase. Because I remember when I was younger, well, I mean, in part, uh, like when I opened my first bank account when I went to college in 2007, mobile banking wasn't even really a thing then. Like the iPhone had just come out that year, right?
Yeah.
And I didn't know anything about finances, so I remember going to the that bank branch on my college campus fairly often, but you know, that was also a different time, so it's hard for me to say if I would do that again today. But I guess I'm wondering if like it it seems like a lot of credit unions and community banks might be looking at the fact that some Gen Zers are visiting branches now, and maybe clinging to that is like, oh look, like almost like justifying the fact that they don't have a strong digital
Yeah.
side. Because like whereas I'm not confident at all based on that data that that's to say like, oh yeah, Gen Zers are going to want to use branches their whole lives. But I feel
Yeah.
like there's also where I was saying it's nuanced, is that there are still lots of people that want branches today. Now, will that be the same uh, 10 to 20 years from now as older generations are no longer, you know, with us? Like, and uh, people in my generation, a little bit older, that are more comfortable with being completely digital, and a lot prefer, maybe not everyone, but I feel like everyone that I know that's in my age
Yeah.
group prefers the digital experience, doesn't want to go to a branch. So that's where it seems like that segment of wanting digital only, or certainly digital first, is growing, and people wanting to visit physical branches is still relevant today. It just seems like it's shrinking. So like, and in my opinion, like eventually will, I believe, probably shrink out of existence eventually. When, and you may have a different opinion on that.
Yeah.
I'm just giving my,
Yeah.
so your
Fair.
thoughts before I keep
Yeah.
going here.
No. So, uh, what's interesting? Here's how I'll respond to that. I don't think there are too many people around that are saying that branches aren't transforming at this point. So the transactional aspect of the branch is almost every financial institution is seeing traditional transactions that decline, and have seen that happen. So people coming in and cashing checks, 20 years ago you'd get a paycheck in your uh, by your time card slot in this weird little metal thing, and you'd grab it, on Friday, and you'd run down to the credit union and you'd cash it,
Yeah.
and you'd put some in here and some in there and some in your sock and all these other things. And that was how 20, 30 years ago things were done. And then, direct deposit came. So all of a sudden, all those transactions started to go away. And now more things are electronic in terms of transferring money. So you don't have, the same thing. Even grandparents are now giving, gift cards, which is a weird, transition for when they used to give checks that you'd have to go to the credit union to deposit,
Yeah.
and you could deposit the check now on your phone. And you've got all of these things that are really diminishing the transaction, what I'll call the transactional activity. We do see that the branches are still relevant for. There's still a lot of transactional activity, but they're not enough to justify their existence alone. But we're still seeing a lot of people who are coming in for those conversations, that advice. And you're right, the younger folks are coming in because they've never bought a car before or set up an account or had any kind of advice. We're also seeing a lot of people that are struggling with how do I do things better? So they come in and say, hey, is there a better way for me to set that up? And that's, somewhat age limitless at this point. When you're 30, you're struggling, is, hey, is there a better way to structure this? Coming in and talking to us and doing those types of things. Or, hey, it's been 5, 6, 7 years since I bought a car. What do I do? From that standpoint, or I need to open this account for my kid. Now, so I'd rather talk to somebody. And there are a lot of people that are comfortable doing that digitally, but there's
Right.
also a lot of people who aren't comfortable doing it digitally. And um, again, part of the reason we're taking the approach that we are is that there still are a lot of people who are comfortable doing that. And there
Right.
will be a lot of
Yeah.
people who are more comfortable doing that for a long time. And you add to that the fact that, if you have a branch in a location, now you're local, and some people love, working with something that's local. It's like, hey, I might never come into you, but I like the idea that if I got a problem, I can walk in and, yell at somebody. Cool, we're here for that. That's part of our job, and there's that type of thing. And then you add the billboard effect. So, don't put your credit union back in the middle of a neighborhood. Put it on the corner of a busy street, so all people see it, and that generates opportunities, and they can see what's going on, all of that type of stuff. And you're even starting to see a lot of the bigger banks starting to do that. Like right now, Chase is actually starting, they went through a branch reduction, branch optimization, and now they're going back into a branch expansion mode. And so they're starting to buy up locations, all over the nation to kind of put new branches on. In fact, there's going to be one going across the street from where we just built a new branch, and there's going to be one that they're putting in. I mean, they're starting to optimize their branch network because they're seeing the value of those service centers and marketing centers. Now, you might not be wrong. 20 years from now, the branch transaction really is having a hard time justify itself. Um, the point is not to try and guess whether you're right or I'm right, or somebody who thinks that neither of us are right and it's some third option is right. The point from a strategic standpoint is to put us in the best position to take advantage of wherever that goes. Like branches right now might be the Schrodinger's cat of financial institutions. It's both dead and alive at the same time. And until you open the box, you're not going to actually know what way that is. So in the absence of that certainty, how do you attack that? Well, you attack that by making sure that you've got opportunities in those other areas like the virtual, and in our case, the commercial, or maybe some other avenue that other credit unions have expertise in. All the same while that you're not neglecting what is still a viable, channel for us. And if you're wrong and all of a sudden people are like, which, hey, let's say there's this, I'll give you a scenario. There's this big run on trust, right? Stable coin gets hacked, it gets wiped out. I can guarantee you people are going to start to, go to physical locations more and more and more. And with all the fraud and stuff that's happening, physical locations are going to start to be, hey, look, I got half my money stolen over here. I want something that I can, do in person, because that's just safer. It feels safer, for me, et cetera, et cetera. That could very easily come out as an opportunity or as a case that plays itself out. But if we're not ready for it, if we're not positioned to be able to take advantage of it and do those types of things, while at the same time trying to make sure that we're cultivating the other areas that are going to be very important, for potential growth. Like, we're not forgetting about the virtual. We're not forgetting about, building out good digital platforms. And anybody, even the best retail shops, need to make sure that their digital platforms at least meet the minimum requirements of the majority of people. Otherwise, you could have the best retail shops on earth, and you're not going to be able to make it if you don't have that omni-channel approach, because so many people these days, kind of use those digital tools.
Yeah.
But that's why we're taking the approach. That's why, like, I honestly don't know if you're right. And I don't think anybody, you'll have a bunch of people say that they know. They don't. In the 1960s, a bunch of people said ATMs were going to kill teller jobs. They haven't. 10 years ago, ITMs were going to take over the world. They haven't. A large regional bank 5 years ago just ripped out all their ITMs because the people were not using them at a way that they were hoping they would from that standpoint. And it was actually creating a drain on their growth. So all of these things are still kind of playing themselves out in the market. So what do you do when it's uncertain? Well, you try and create paths of opportunity through the uncertainty. And I kind of use this thing that looks like a baseball stadium as an analogy. And if you think about the outfield as a horizon, a potential horizon, on one side you've got the absolute one case. On the other side, you got the absolute other case. So let's take branches. One case is branches are going to, digital is going to go away because, I don't know, there's a nuclear war or something, and there's no electronics anymore, so branches are going to be this, 100% of everything. The other side is branches are completely dead. There's nothing for that. Those are our field of possibilities in the potential array. And what we have to do is say, okay, I can't plan for, the nuclear war. I can't plan for branches to be completely dead. It's just not realistic from that standpoint. But what is the widest range of possibilities that I can plan for today? And I can, implement a strategy so that if the world starts shifting one way or the other in that array, I can pivot relatively quickly without having to, completely redo my organization or completely re-amortize everything that we're doing. That is how we kind of approach it. So in my case, I'm like, hey, I don't know if branches are going to die or, slowly, go out of existence. I don't know if that'll be 10 years, 20 years, 30 years, 40 years. But what I do know is that a lot of people want digital, so I need to make sure I'm good there. And branches are still very relevant, so let's do that. But let's not make them in the same way that we're doing them for transactions. Let's make them as more service centers, and let's spread them out a little bit further than we have currently. And let's start doing some of those things that keep their relevance, keep it as a viable channel for us, but yet doesn't necessarily commit me specifically to one course of action or another in regards to branches.
So let me give you a hypothetical.
Mm-hmm.
Let's just pretend tomorrow is the day where it's declared branches are not relevant anymore.
Okay. Yeah.
Done. So then would your move be to like, okay, we're going to shut down all of the branches and like obviously continue to invest in digital?
Yeah, yeah. I mean, essentially, and for any of my team members that are listening, this is a
Hypothetical,
pure hypothetical.
hypothetical. Yeah. Don't mean to make.
Yeah, yeah. In my estimation, it's probably a ways out before that.
I
But
agree.
to your point,
Yeah.
to your point, that's exactly what we do. We'd say, hey, this is no longer a viable option. Let's pour all of our resources into the other two growth channels that we've identified, which is why designing them in a way that even though they rely on each other today, could very easily segment themselves off into their own units, makes it that much easier should something like that, come about.
Yeah.
Or let's take the virtual space. I mean, if we were able to create the virtual experience that did not require a branch or a physical location, and it was, top the experience was best in class and all this other stuff. Well, why wouldn't we potentially want to take that to other areas where we have no branches, maybe sub brand, as you kind of talked about in the first thing. I can't do that if I'm building it with the idea that it's meant to augment our branches, which a lot of technology, a lot of digital banking, especially for community based organizations, were more, well, this is an augmentation to our branch. It's another way for them to check their balances and do those types of things. Well, if you build it with that augmentation idea, or hey, we don't have to make this experience very good because in the app, because we can just send them to the branch to finish that.
Yes. Yes.
You start to lean too heavily on the other things if you're not thinking about them as their own standalone kind of opportunities.
Right.
And if you do that, then you're for sure going to limit yourself to just where you are around a physical branch, and it's just going to be an augmentation to that, and you're going to artificially limit your potential for growth. Now, if you think about it as, hey, this needs to be able to stand alone. Everybody needs to be able to interact with us purely for here. Frankly, I should be able to do all of your banking. You're sitting in Salt Lake City,
Yep.
was it?
Yep.
Yeah. You say I should be able to do all of your banking if you so desire. And you're talking with me, and you're like, wow, I like this guy. I like the organization. I want to take all my business to you, which you should think about, because we can do that for you. But we should be able to accommodate that
Yeah.
from that standpoint if we're doing it right. And that's part of the reason we're thinking about it this way. And then on the commercial space, same thing. Let's say retail goes away because stablecoin comes into play. It removes the cash, the need for storing your cash at a financial institution, because you can store it on some central ledger that may or may not have been created yet, Ethereum, something like that. You start to all of a sudden, well, retail isn't viable anymore as a banking option as part of the financial institution industry. So commercial, though, still relies on relationships. So here we go. Now that's the type of stuff that you have to think about when you're building it. But yet at the same time, we do know that we have these other things to lean on. So you got to make sure that they integrate, they work together, that they're doing all those things, but that they can survive alone if you need them to.
Yeah, because it seems like what's happening with most credit unions and community banks is that they're still primarily focused on being a branch-based institution, and they're it's almost like everyone knows that digital is important, but the way that they approach it is like a bolt-on, and the result is in like the existing structure where everything like for decades they've operated as a branch-based institution. They're not built like they don't have the people, they don't have the technology to deliver a digital experience that's on par with fintech.
Yeah.
And uh, like the resources to do that are like, it takes money to run the branches and to build new ones. And that's money that's going into that instead of going into the digital. And so they end up
Yep.
with these subpar digital experiences. So
Yeah.
how do you make sure that that digital side gets the resources it needs to build a solution that's on par with fintech, and now even I think even a lot of fintechs are going to face the possibility for disruption with what everything that's happening with AI. And I mean I
Yep.
believe we're going to start to see more AI first banking experiences in the next few years. But whether we're talking about launching a like traditional mobile app and online banking or a new AI first banking experience, how do you make sure that those get the requisite resources and they're not smothered by
Yeah.
basically by the status quo of how the organization is run for decades?
Yeah, no. So that's the absolute crux of the issue right now is where do you invest your money? How do you invest? Um, are financial institutions ever going to my size or smaller ever going to be able to put the same amount of development into a tool that the fintechs do? Because fintechs take a very small segment of things of the world and hyper focus hundreds of millions of dollars of VC funds onto that problem
Mm.
and create very nice solutions. And then, eventually, the rest of the world kind of catches up just a little bit because, other developers see that they create white box tools that we then purchase to implement and do those types of things. And it's really trying to so I don't know of too many credit unions that can or even should try and compete with, we'll say, the pace of technology advancement as fintechs versus being fast followers, mid followers by doing some of that because the investment's just almost too much. Now, the flip side of that is a little bit interesting. So let's take Amazon, right? So Amazon has all of their retail and stuff like that. There are still a lot of retail stores. So imagine if there were, and this is kind of what's out there. Walgreens has a website where you can buy stuff. Walmart has actually probably as big a retail virtual presence as Amazon to a certain extent. There's Amazon, but the mom and pop shops are finding ways to survive, by joining that ecosystem,
Mm.
yet still being local and things like that. That's kind of how I see financial institutions, continuing to grow is leveraging, there's always going to be fintechs that help those mom and pops to kind of leverage it. So we're not going to get kind of aced out of everything. And I, I think that's how credit unions should kind of approach it. But at the same time, you're right. A branch today costs about $6 million to build, $5 to $6 million. Okay, what if you took that $5 or $6 million and put it into updating your system,
Mm.
to the point where you can kind of keep up? There's that balance there that I think everybody's. I think a lot of credit unions, not all, but I think a lot of credit unions kind of understand that. They just might not quite be able to get out of the rut, so to speak, at this point, to try and figure out where to put that money for the next layer of growth.
Mm.
And it's not an easy decision. It's not an easy decision. I mean, imagine, if I said, hey, you got to spend, $1 million a year for the foreseeable future on a new tool to generate, try and generate business that you don't know if you're going to get from that standpoint. Yeah, it's kind of a tough. It's a tough decision, but that's why we're all kind of here and why we're in business is to try and figure that out.
Yeah, that is the dilemma.
Yeah, yeah. So it'll be really interesting. So I was just talking with somebody, and they're right, and I've heard this in other places. But the next 5 years, the change that's happening in the next 5 years is probably going to be more than the last 20 years that came before us. And the 20 years that came before us was more change than the 200 years that came before that. So the pace of change is happening. It's continuing to roll faster than almost any of us can kind of keep up with from that standpoint. So to kind of maybe come back to the original premise and put a bow on it, the strategy, or at least our view of it, my view of it, is the strategy needs to be one that maximizes your flexibility through these rapidly changing times. And that's going to look different for everybody, but nobody really truly knows. Like even AI now, 6 months ago it was going to change the world. Now there's a little bit of a recoil on it, and then it'll spring back, and eventually it'll settle itself out where it's going to kind of be from a trajectory standpoint. But if we're trying to guess on the front end where a lot of this stuff is at our size, at our resource base, and all those other things, we're going to potentially be wrong more than we're going to be right. It's like betting. The house wins. Usually. So what you do is you try and find those games that you can kind of mitigate and create the most opportunity for yourself as you go through it. And that's our strategy versus trying to pick the winners of what's going to end up happening from a technology space. Is kind of let that shake out and be ready to pivot into it when it becomes more clear what that direction is going to be.
Well, thanks, Chris. This has been a really interesting conversation.
Yeah. No, my pleasure. I love talking about this stuff. So
Same.
Anytime you want.
Okay. Yeah. Good to talk again.
All right. Thanks, Derek. Appreciate it.